2020 has been a crazy year for the stock market, with many companies going bankrupt, while the FANGs, Facebook, Amazon, Apple, Netflix, and Google, all rising in value, becoming very costly. You might be asking, what makes the FANG stock so costly? And what is the PE ratio? The PE ratio is the price to earnings ratio. Is the current stock offer cost divided by the profit per share. For example, if company ABC has 1 million portions of stock currently priced at $20 and offer earn $2 million in income, or $2 per share, then the PE ratio would be $20 divided by $2, which gives a ratio of 10. Another way of looking at this example would be, how long would it take to make money back if you purchase all the portions, $20 million? Assuming the company consistently earns $2 million per year, it would take 10 years to recoup your investment, which is a long-term ROI of 7.2% per year. Not bad at all. But what's an acceptable PE? 20 is the typical benchmark of a good PE ratio, but it depends on the industry. It's difficult to compare tech companies like Apple with a retail company like Costco. The lower the PE ratio, the less expensive the stock is, and vice versa. Currently, the high worth of stocks does not correlate to the Dow, which is presently at around a PE ratio of 29 and over, nearly double the historic average of 15, which is why I don't invest in the stock market today. At the time of this video, the FANG PE ratios are 34, 119, 34, 85, and 34. It's obvious that the stocks are overvalued and investors are seeking alternative investments like gold, which doesn't cash flow and has hit all-time highs after the Great Recession. It crashed to its all-time low shortly after. Now, sophisticated investors should look into recession-resistant investments, cash-flowing, stabilized apartment buildings with some value-add opportunity in there to bump the rents up. We're looking for strong existing cash flow already in place with all-time low interest rates. Now is the time to take on good debt and be ready for inflation, because it's coming. How else are we going to pay for all this government stimulus? My stock portfolio can be compared to a person with an infection being suddenly struck and weakened. My multifamily portfolio acts as a vaccine, keeping my overall net worth intact, helping me stay afloat during downturns. Over my 4,200 unit portfolio, we're still well above 90 to 95% collections through this pandemic. When the government prohibited courts from evicting tenants, there were no noticeable changes in rents, and collections kept coming in. The steadiness in my portfolio may have been because, after all, people need a place to live, and they need good value-based places to live between the $700 to $1,200 range. And at the end, it comes down to supply and demand. This country needs more value-based multifamily options for regular people out there. Quit speculating in the stock market and invest in real assets.